I want the government to live within its means. I don't want the federal government to borrow any money. Maybe if we have a lower credit rating, that's a way of getting a balanced budget. We would be better off with a balanced budget anyway. So I don't care if our debt gets downgraded. But, in my mind, if we actually got our fiscal house in order, which included, a restructuring of our treasury debt, we would actually be a better credit risk at that point. Just like, if somebody goes through a bankruptcy and they get rid of all their credit card debt and a lot of stuff and they have a clean slate, you'd probably you'd be more willing to lend that person money after they've already wiped out all their debt, than before when you might end up, as just another creditor in a bankruptcy. So there's going to be massive inflation to anybody who buys U.S. Treasuries now. But if we can get our fiscal house in order, reduce government borrowing, reduce spending, balance the budget to the extent that we did need to borrow money for an emergency, we'd get a better deal. We actually needed it. But I don't think the government should need to borrow money. They have the power to tax. If you want to pay for something, then tax the people to cover the cost. And if the people don't want to pay the taxes, then don't do it. The taxation keeps government honest, right? But with inflation, the government gets to pretend they're giving people something for nothing. We can have all these programs and you don't have to pay for it. Well, if I don't have to pay for it, sure, I'll take the program. But if you want me to pay for it, well, maybe I don't actually want it. And I think if Americans got the bill for a lot of these programs that they claim they want, they really wouldn't want them.
What would it look like to get a haircut in the bond market? So it makes sense in terms of cutting entitlements, but what does that look like in terms of the creditors in the United States?
Well, again, they take an honest haircut instead of a dishonest one. Look, nobody's going to get their money back. I mean, that is reality. So the question is, how are you going to lose as a creditor of the United States? Are you going to lose because America doesn't pay you everything that was promised? Or are you going to lose because they pay you what was promised? They just pay you in money that doesn't buy very much. So you're either going to lose to honest default or you're going to lose to inflation. But those are your only choices. You're going to lose no matter what. I think if we act fiscally responsibly now, which would include a restructuring, our creditors are actually going to lose a lot less.
How does the banking crisis play into all of this? Like, obviously, we saw that there was this immense outflow from banks like Silicon Valley Bank, et cetera. We saw the Fed, the OCC, the Treasury, and other organizations step in and basically backstop all deposits in the United States. There's a debate as to whether that is an inflationary action or it's not. How do you read into the banking crisis?
Well, the banking crisis was a byproduct of everything the Federal Reserve has done, everything the U.S. government has done to create that crisis. They set the stage for it, by insuring bank deposits. They never should have done that. Of course, that goes back to the Roosevelt days, right? It started in the 1930s, but it was a mistake, and the moral hazard has grown ever since.
Why do you think it was a mistake?
Well, because the government shouldn't guarantee anything. I mean, banks should have to stand on their own creditworthiness. Banks should have to compete with one another in a free market based on safety. That should be a primary criteria. Where do you want to put your money? Well, I want to put my money into a bank that doesn't do dumb things with it. I recognize when you open up a bank account, you are a creditor of that bank. You are loaning money to the bank. Well, how is it that you can loan money without any regard for the ability of the bank to pay you back? I mean, only the government has done that. In a free market, the banks that had the best balance sheets, the best loan portfolios, those are the ones that would get the deposits. Today, the bank that gets the deposits is the one that's closest to your house, or whatever has the easiest website to navigate. No one gives a damn about what the bank does with your money because the government has got it all guaranteed. But also, the government kept interest rates for the Fed at zero for a long time. And so the only way the banks were able to generate any return was to go out long term. Even though the returns were low, there was no return on the short-term money. So the Fed basically encouraged all these banks to take on the long-term debt. Look at the mortgages. I was talking about this for years. Nobody else was. When everybody was talking about how great it was that Americans could refinance their mortgages at 3%, I kept saying, yeah, but what about the other side of that coin? What about the banks who are going to be stuck owning this paper for 30 years collecting 3%. What's going to happen to those banks when interest rates go up, right? The borrower's gain is the lender's loss. So we basically created a ticking time bomb for all these banks that were on the other side of the refinance boom. And the same thing with all the treasuries that they bought. And another reason that banks were loaded up on treasuries and government guaranteed mortgages was because the banking regulators encouraged banks to own them, because they punished them if they owned anything else. They forced them to take big haircuts on those positions, which impeded their capital. The deal that the regulators made with the banks, if you own US treasuries, if you own a government guaranteed mortgage, you never have to mark it to the market. Doesn't matter how much value that asset loses, we're not going to count it against you. So the banks bought it because of that, those favorable accounting treatment. Now, the banks just said, well, we can pretend that we don't have these losses because we're just going to claim that we're going to hold these assets to maturity. Well, how do you know if you own a 30-year asset? How do you know you're going to be able to keep it for the next 30 years? What if something comes up and you need to sell it, right? Well, they just pretended that nothing would come up. Well, you know what's come up? Rates have gone up. And so now the banks are in trouble because their customers want their money back. Why? Because they can put it someplace else and get a higher yield. Why leave it locked up? The depositors are not locked up. The banks, they're locked up. That's why for years I was warning about these banks again. Everybody was saying on Wall Street, oh, interest rates going up is going to be good for financials. I said, no, it's going to destroy the financials because it's going to blow up their balance sheets. It's going to cause huge losses for the assets that they own. And that's exactly what happened. So this was not something that came out of left field. Just like the 2008 financial crisis, it was easy to predict. That's why I was able to predict it, right? I can only predict stuff that's easy to predict, right? I'm not that smart, right? So it has to be pretty obvious for me to understand it early in advance. And so this is, something that I was talking about, a warning about, that everybody else was clueless about until it happened. And then, of course, their solution, more government bailouts, more money printing, actually makes the ultimate problem worse.
How do you think about it being a government bailout in terms of they let the equity and the debt holders fail, but they save the depositors? Is that still considered a bailout in your mind? And is that a positive or a negative thing? Should they have allowed people with more than $250,000 in those accounts to just go to zero?
Well, yes, they should have, because now here's what they've done. They bailed out the large depositors, but in doing that, they communicated to the public that all banks don't necessarily enjoy that protection, that it's a case-by-case situation. When a bank fails, that the Fed, the Treasury are going to evaluate the impact that that bank failure might have on the economy or whatever, and then decide whether or not they want to cover the large deposits. And that created a huge problem for a lot of regional and community banks, because now you have the large depositors who are thinking, I've got my money at some small bank. And if this small bank fails, the FDIC coverage for my account, let's say I got $5 million at some small bank, I may not be covered. So I'm going to take my money out of that little bank. I'm going to send it to Bank of America. I'm going to send it to some big bank that's either too big to fail, or if it fails, I know they're going to cover everybody. So the government has actually accelerated the run out of smaller banks, because why would you put your money into one of those banks? Given the fact that, all these banks are in trouble. So why take a chance? It's not like they're going to be able to pay you more interest. And if they did pay you more interest to offset the higher risk that you'll lose your money in a default, it's going to put those banks at a competitive disadvantage. So what the government has done is now they're moving towards even more consolidation in the bank industry because they've created this problem. Now, of course, the solution to that problem is, okay, let's make this an explicit guarantee. We're going to guarantee everybody's account, no matter how large, no matter where it is. But then that's an even bigger problem, because where do you get the money to do that?